We want to chat a little bit about what's going on with rates in the economic environment. And well, this is the first quarter of 2024. They go up and they come down, and it's kind of an erratic period for interest rates. Generally speaking, the trend is down, but we had some economic news. In particular, rates were driven by the Fed and inflation. Inflation is the number one thing that drives rates. The Fed has two mandates: keep inflation down and keep employment high. And sometimes those can be counterproductive or opposite each other. And they're going to focus on inflation because inflation rewards everybody's earning power, as we know. And it has not been fun the last couple of years because it's been up in the 8% range, which is not the highest that the United States has ever had. Back when I was just a lad, maybe a little more than a lad, but in the 70s, 80s, I wasn't in mortgages yet. And I believe people were buying houses with interest rates on mortgages in the 12% range, maybe a little higher than that, which is, from our perspective, stunningly high, in particular because we got spoiled in 2020, 2021 with rates in the threes and places like that. So they're really nice. And now rates are higher. And the reason for that is because inflation kind of got out of control. It's driven by a number of factors. The Federal Reserve, as you know, is the central bank of the United States, and they basically control interest rates. That's kind of a little oversimplification, but they have some levers, they call them, to move and to change things so that interest rates may go up and may come down. They had something called quantitative easing, which is another whole topic which we can talk about sometime, which is why rates were so phenomenally low for the years that they were. But that's been done and gone, kind of anyway. And now what they're doing is they're using what's called the federal funds rate to change things. And in so doing, they make it more expensive for us to borrow. That's just the simplicity of that. And they're looking at two indicators, and inflation is one of them. So getting down to the point here, there's the consumer price index, which is a measure of inflation effectively, but it doesn't have the two core components which really drive things and are really erratic. One of them is energy, gas prices, right? And the second one is rents, basically housing expenses. And those two things are very erratic, and two components which are they drive the number up or down kind of erratically, so just because they have such a high weighting in the consumer price index. So a few days back, I think it's been now probably a week ago, the consumer price index came in all of 0.2% higher than what they thought. 0.2%. The markets went bonkers. So the stock market went down because of that, because it's higher inflation than what they anticipated. And rates took a decided jump, in particular 100 basis points. What the heck is that? That is 1 point in fee for the very same rate within days. So that 1 point is 1% of your loan amount. So if you get a $400,000 loan amount, 1 point is $4,000. So if the rates jumped 1 point, or 100 basis points, we call it in the mortgage industry, that means that loan is $4,000 more expensive for the very same rate within days. And that's significant, for a lot of people. It started coming back down again, and we all thought that the producer price index, which is CPI without those two components in there, was going to come in lower and everything was going to get settled down. Well, guess what? The producer price index came in 0.1% higher than what expectations were. And so rates were kind of erratic and jumped around. They didn't go bonkers, partly because the Fed also uses what we call Fed speak to control the market. And it was, I believe, the New York governor of the Federal Reserve stepped out and said, calm down, everybody. It's a couple of indicators. They go up, they come down. We're not going to get carried away here. But what it really did, we thought the Fed was going to be lowering interest rates because that's the expectation this year. Rates are going to come down. The Fed's going to lower short-term rates 2 or 3 times. We thought it was going to happen in March. Now we don't think so. So that's why mortgage rates are kind of stubbornly hanging in there a little higher. It looks like it might be May. And then who knows? Because other things impact rates, like international events. A war breaks out someplace. So there's an oil embargo. So gas and oil are higher in the United States. That's called inflation. There's a lot of stuff that drives it. And I'm talking around and around here about it. So questions on that, ladies, today?
I do have one question. I don't know if this correlates to what you're talking about. But we are in an election year, and oftentimes there's that notion that because we're going into election, that's automatically going to make rates go down. I don't know why the thought is on that.
Exactly. Why? I think that's such a great question, and I don't know that I have a definitive answer on that. I've been wanting to research that exact topic, Stephanie, for years because everybody says, well, I'm going to wait till after the election before I do whatever. And I go, why? It's not like there's fiscal policy that drives things, and there's taxation and all of that kind of stuff that the government can do, and there's what monetary policy, which is what the Fed does. The Fed's monetary policy is by far the most thing that drives the traditional one. They have the levers they can control. Fiscal policy, taxes and all that kind of stuff, which is what, and different administrations truly they back off on taxes, and you know how it is kind of thing. That has a long-term impact on the economy, but not much of a short-term impact on rates. That's my own personal opinion. And I'd really like to dive into that a little bit more and see just how much the election does impact rates and people buying and selling. It's a good question.
My thought process is I just don't foresee this year changing all that much in rates because of the election, where maybe in the past years you might have seen it dip and it might have made a significant difference. But what I'm seeing is we're trending pretty steadily. And like you said, we are, it can be pretty volatile with that up and down. But if anything, I feel like we might see those actually come up a little bit more because inflation in and of itself is not being helped at all right now. So I don't really foresee that changing. So in my opinion as well, like, I just feel like if somebody's looking to buy or sell, I would not be holding out thinking that you're just going to see some magical drop because of that election. I think we can kind of debunk that this year in particular.
Yeah, we'll see. I don't really think the election is going to have a lot to do with rates, but we'll see.
Yeah. Well, okay. Who really knows, right?
We'll find out.
I need a crystal ball.
I read, so there's a couple of economists I follow, and I read one of them recently who said economists have an abysmal record in predicting what things are going to do. Abysmal. But that's because there's so much data out there that impacts things, and they try to quantify it, and we all talk ourselves even into believing the models that we have, including the Federal Reserve. I mean, they do their best with what they have, but there's so much going on that we don't have any control over whatsoever that impact things, including consumer sentiment. If people just kind of get in their mind, and this has been shown historically, if they get in mind that inflation is going to continue, then inflation continues just because they think it's going to continue. And then they have the wage battle, right? Because we need to increase wages to keep up with rising prices. Well, you increase wages, and that causes the companies that pay the wages to have to charge more for their goods to pay for the higher wages they're paying. And it's a perpetual thing that keeps rates going up with inflation, or sometimes even going down and get deflation, which is a whole nother conversation and equally damaging when you have deflation. So that's why the Fed has a target, by the way, which is 2%. They're trying to get the inflation gauge that they're following, and I believe they follow the producer price index more, to be a 2% level. And there's some measures of that now that we're really, really close. Some measures I'm talking about when they take into account lagging indicators, because these are averaged out over a long period of time. So you take into account the lagging indicators are keeping it up and things are lower now, that we're getting really, really close. And the Fed knows that, which is why they stopped increasing rates, even though inflation is not down to 2% yet, because they know that it's going to come down on its own, and they don't want to get carried away and get deflationary and cause one of those horrible things called recessions. And technically, we're not in a recession yet. And we might even get that soft landing that they've been talking about. All fun stuff that we talk about in the mortgage industry every day. So there you go.
Perfect. All fun things. All fun things.
It's a fun conversation. That's what we talk about around over beers when we're done with the mortgage day, guys. So there you go.
Inflation, the thing that makes us lose sleep at night.
Hey, question for us, individuals, just single individuals over here, what could we be doing to help with that inflation issue? You said, like, if we have that mindset that's going to continue, that's kind of like not the direction we need to go. As individuals, what would you recommend?
Wow, there's a great question too. It's really difficult to say any one individual or even much of a group of individuals is going to have a lot to do with driving economic things of this, especially with the economy the size of the United States, which is, huge. The largest economy in the world, right? I suppose we could all chip in, psychologically speaking, and spread the word that inflation is coming down, guys. And so isn't this great? And then everybody else will spread the word. And even that alone, like I said, consumer sentiment is something they measure, as a matter of fact. Are things looking good or are things looking not so good? There's a study of that. I think they test that weekly or monthly, no more than monthly, to find out what consumer sentiment is like. And that helps drive markets. Maybe
Okay,
that.
it's fine.
Be optimistic there, Rosella. Go ahead, Steph. I'm sorry.
I'm spreading the good word, sir. I'm spreading it.
Fair
I
enough.
was actually going to say that's, I mean, how your question was, is what can we do as individuals?
Yeah.
Well, number one, pray. And number two, go out and manifest the good thing. It's coming.
That's a better answer. I like that. Pray first, and then get out there and spread the word.
Yeah, exactly. We're going to bring this our way. We need good things our way.
Very good. Well, fun chat on my part. I always enjoy talking about stuff like that. Thanks, ladies.
Yeah, thank you.
All
Very
right, take
informative.
care. See you next time.
All right, bye.